Just recently I posted a new video discussing all the latest bad news affecting Medical Properties Trust. It really boils down to 5 things. Firstly, the company is expected to lose ownership in its Steward hospitals in Massachusetts, marking a total loss for Medical Properties Trust as well as its JV partner MPW. Secondly, I fear that this bad experience is going to make it a lot harder for Medical Properties Trust to raise more JV capital going forward, and this is very bad news because it desperately needs to sell more assets and JV interests in order to raise capital and address its near-term debt maturities. Thirdly, this also puts more doubt on Medical Properties Trust's ability to re-tenant and monetize its Steward's assets, which is an important part of our investment thesis. Then the fourth piece of bad news is that the company cut its dividend once again, and then the fifth and finally it also hinted at a potential share issuance which would be highly dilutive to shareholders. All of this still remains true today and there's no need to sugarcoat this bad news. However, just a few days after posting this video, some good news came out, and that's what I'm gonna cover in today's follow-up video. Hey everyone, this is YCHARTS, I run a small investment firm that specializes in REIT investing, and before I go into this update on Medical Properties Trust, I want to remind you that I just recently created a new Substack where I post a lot of free research on some of my top picks in the REIT segment. If you want to access my Substack, I'll put a link to it in the description of this video. So there are really 3 pieces of good news here. The first one is that the company just announced some more asset sales. On August 14th, it announced that it had sold a portfolio of 11 hospitals in Colorado for $86 million and plans to use these proceeds to pay off more debt. This is great news because Medical Properties Trust has significant debt maturities coming its way, and that's the primary concern of the market. The REIT has already done a great job at addressing its debt maturities in 2024 and 2025 by selling assets, but now with these further asset sales, it's able to start working on its debt maturities coming in 2026, which are also quite significant. But this is also great news because the REIT had only invested $64 million to fund the construction of these properties, and it was able to sell them at a $22 million gain, even despite the tough market environment. This positive outcome is especially interesting knowing that the tenant of these properties had gone bankrupt and Medical Properties Trust had to release them to another operator. Here's what the REIT said in their press release. Construction of the 11 facilities was funded by Medical Properties Trust for the original operator Adeptus Health between 2015 and 2017 at a total initial cost of $64 million. Shortly after Adeptus filed for Chapter 11 bankruptcy protection in 2017, UC Health leased the facilities from Medical Properties Trust without interruption to Care and with a nominal rent concession reflective of UC Health's strong credit quality. What this shows you is that Medical Properties Trust was able to release the properties to a very strong operator, and despite giving a small rent cut, it was still able to earn a very strong returns on these properties. That's exactly what we're hoping will happen with most of the Steward properties, and therefore it's quite encouraging for shareholders. It seems to reaffirm that the company's underwriting perhaps isn't quite as bad as many people make it seem to be, and it shows you also once again that the company still owns some desirable assets that it can now tap into as it sells them to raise capital to pay off debt maturities. The second piece of good news is it appears that one of the main short sellers is now moving on to something else. And here I want to clarify that the short sellers of Medical Properties Trust really deserve a lot of credit. They took a contrarian view a few years ago when the share price was a lot higher. The sentiment was generally bullish for the company, and in hindsight they were 100% correct. They discovered some issues that many investors, including myself, had overlooked, and they ended up doing really well on their investment. However, it appears that now, following the crash of the share price of the company, the short sellers are moving on as they've removed it from their active shortlist. This, of course, doesn't mean that they are now turning bullish on the company. On the contrary, I'm quite confident in saying that they're probably still bearish and still hold a very negative view of the company. This is evident if you look at their latest tweets about it, but I think that it does indicate that perhaps their confidence in seeing the share price decline further from here is now decreasing, or that at very least the risk to reward of shorting it further is not quite as attractive as it used to be. I think that this is good news and should help the market sentiment of the company going forward. Hey, before I go into the third piece of good news, can you please do me a huge favor and click the like button? That will help me a lot to keep growing this channel. Thanks so much in advance. The third piece of good news is that it's now become increasingly likely that we'll see quite significant rate cuts already in the near term, and I think that this could be even one of the reasons why the short sellers decided to close their position. Over the past years, the main focus of investors concerning medical properties trust have been its tenant issues, fraud allocations, the short thesis, and so on. And I think that with all of that, a lot of people have forgotten that this is a REIT. It has a lot of debt, and therefore the declining interest rate should be a very strong catalyst for the company. Over the past month, we've seen many highly leveraged REITs like Unity Group, Industrial Logistics Properties Trust, and other highly leveraged REITs, lower quality REITs, surge in value very significantly as a result of the anticipated rate cuts. But Medical Properties Trust has so far missed out on this to a large extent, again, because the focus has been on something else. But as interest rates are now cut, I think that the focus might change a little bit. The narrative could improve for Medical Properties Trust because suddenly the market might not be quite as concerned about the REIT's ability to refinance its debt. Right now, the debt market is predicting that interest rates will be about 200 basis points lower in a year from now, and this is especially good news for Medical Properties Trust because it will allow it to sell more assets, because suddenly many more investors will become more interested in investing in hospitals than they've been in previous years when they were able to get a 5% yield or even more on the money market funds, treasuries, and bonds. So I think that this is going to lead to more capital flows towards alternative investments like hospitals. So this is great news for Medical Properties Trust, as again, it needs to sell assets to pay off debt. This is going to become easier. Then secondly, it's also going to improve the health of some of its tenants that are highly leveraged and owned by private equity companies. And then thirdly, ultimately, I think that this will lower the risk of Medical Properties Trust going to zero, facing bankruptcy, because it wouldn't be able to refinance debt. So this is very good news and it's encouraging for shareholders, but ultimately my thoughts on the company have not changed materially. I still view it as a high risk, high potential reward type investments, and I think it's relatively attractive in terms of its risk reward for aggressive investors, given that I think that the majority of its assets will do relatively well over time. I think that the steward overhang will be removed in 12 to 24 months from now, and finally, I expect significant rate cuts which should support a higher equity value. However, I've been wrong before and I could be wrong again, and this certainly isn't my highest conviction in the REIT segment today, just a tiny position as part of my diversified portfolio. I have a high risk tolerance, and there are many other REITs that should more than make up for Medical Properties Trust, even if it becomes a total loss over the long run. If you want to access my entire real money REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. You won't be charged anything in the first 14 days, so if you want to just come in to see the research, access our latest trade alerts, our course to REIT investing, that's perfectly fine with me. Again, if you cancel within the first 14 days, you won't be charged anything. And then if you decide to stick with us for the long run, you also get a $100 discount compared to what future members will be paying. Thank you very much again for your interest. See you at my next one. Bye-bye.